Back in 1929, the stock market collapsed, and the United States plunged into what we call the Great Depression. The market hemorrhaged 89% of its value over a 3-year period. 1 in 4 Americans couldn't find work. Banks went under left and right. People's life savings vanished overnight. It took a full quarter century for the markets to climb back to where they'd been in 1929. Then, in 2008, the housing sector imploded and dragged us into the Great Recession. Stocks shed 57% of their value in just 18 months. Unemployment hit 10%. Banks were lining up for government rescue packages. People watched their retirement nest eggs get shredded. The markets needed 5 years to recover their losses. But what's brewing for 2025 is fundamentally different. Right now, stocks, bonds, and real estate are all collapsing at the same time in what financial historians are calling the everything bubble. And when everything goes down together, you've got nowhere to run and nowhere to hide. What if I told you we're not facing some unprecedented situation? We're living in 1928, right on the edge of the Great Depression. Except this time around, it's actually worse because the mechanisms that rescued us after 1929 and again after 2008 simply don't exist anymore. The Federal Reserve can't slash interest rates down to zero because rates are already sitting at low levels. They can't print unlimited quantities of money because they just tried that and triggered the worst inflation we've seen in 4 decades. The government can't bail out everyone because it's already suffocating under $36 trillion in debt. Let me walk you through why every single major financial indicator is screaming danger. Why the crash window sits between November 2025 and June 2026. And why the collapse that's coming will obliterate more wealth than any single event in the entire span of human history. This isn't me speculating or throwing out theories. This is pure mathematics. To grasp why 2025 is different from every crash that came before it, you need to understand that we're not dealing with one bubble. We're sitting on 3 simultaneous bubbles that have never all existed together in the history of finance. Let's start with the stock market. The S&P 500 is currently trading at a price-to-earnings ratio of 28, which is damn near double the historical average that normally sits between 15 and 17. This kind of extreme overvaluation has only happened twice in the past. In 1929, right before the Great Depression hit, and in 2000, right before the dot-com crash that wiped out 78% of the Nasdaq's total value. Both times, the market went into freefall within months of reaching these absurd extremes. But the concentration risk we're facing in 2025 makes the situation even more dangerous than what we saw in either 1929 or 2000. 7 companies, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, represent roughly 30% of the entire S&P 500's total market capitalization. What this means is that if these 7 giants crash, they drag the entire market down with them. This kind of concentration hasn't been around since 1929, when a small handful of industrial stocks propped up the entire market right before everything collapsed. In 2000, sure, the dot-com bubble was concentrated in technology stocks, but they made up a smaller slice of the overall market. Today's concentration is more extreme, more dangerous, and more fragile than anything we've experienced. Nvidia by itself illustrates just how insane current valuations have become. The company trades at a price-to-earnings ratio north of 65, which means investors are paying $65 for every single dollar of profit the company actually generates. Nvidia's total market value exceeds $3 trillion, making it worth more than the entire German stock market. And Germany is the 4th largest economy on the planet. This isn't rational valuation based on fundamentals. This is pure speculation driven by artificial intelligence hype that mirrors the exact same internet hype we saw in 1999. Everyone believed the internet would transform everything, just like everyone believes AI will transform everything now. They were absolutely right about the internet's long-term impact. They were catastrophically wrong about short-term stock valuations. The exact same dynamic is playing out right now with AI. The second bubble is real estate, and it's actually more inflated than the 2008 housing bubble that nearly destroyed the entire global financial system. As of November 2025, home prices sit approximately 50% above their long-term historical trend when you measure them relative to income and rent. At the absolute peak of the 2008 bubble, homes were 35% above trend. This means the current housing bubble is 43% larger than the bubble that caused the Great Recession. Let that really sink in for a moment. The crisis that required trillions in bailouts and came within inches of destroying capitalism itself was fueled by 35% overvaluation. We're sitting at 50% overvaluation right now. And most people don't even realize we're inside a bubble because prices have stayed elevated for so long that it feels completely normal. But residential real estate only tells part of the story. Commercial real estate is in absolute freefall, creating a slow-motion crisis that will accelerate dramatically through 2025 and 2026. Office buildings across America are sitting 45% vacant as remote work becomes a permanent fixture of the economy. San Francisco has a 35% vacancy rate in commercial office space. These buildings were financed with mortgages when interest rates were sitting at 3%. Now, those mortgages are coming due and need to be refinanced at 7% to 9% interest rates. The buildings aren't worth enough to support the new debt service when interest rates have tripled. This means mass defaults, massive bank losses, and a cascade of failures that will mirror the 2008 subprime crisis, except this time it's happening in commercial properties instead of residential ones. The third bubble, and this is what makes 2025 completely unprecedented, is the bond market. Government bonds are supposed to be the safe asset you retreat to when stocks are crashing. In 1929, bonds remained safe even as stocks collapsed 89%. In 2008, Treasury bonds actually rallied as investors fled from stocks into safety. But in 2025, bonds are crashing right alongside stocks because the US government has issued so much debt that the bond market simply can't absorb any more of it. Total federal debt exceeds $36 trillion, sitting at approximately 125% of GDP. This is the exact same debt to GDP ratio America carried at the end of World War II. Except after World War II, America was the only major economy that hadn't been destroyed by war. Today, America is competing with countries that carry lower debt loads and have stronger economic fundamentals. The annual interest payment on this debt has now surpassed $1.2 trillion per year, making it the single largest line item in the entire federal budget, larger than defense spending, larger than Social Security. When your interest payments exceed everything else, the government faces three choices. Cut spending drastically and trigger a recession. Raise taxes drastically and trigger a recession. Or print money to pay the debt and trigger inflation. All three options lead directly to economic crisis. There's no good path forward when your interest payments alone equal the entire GDP of Mexico. This is the everything bubble. Stocks overvalued at levels only seen twice before, both times right before crashes. Real estate more overvalued than 2008. And bonds, the traditional safe haven, crashing under the weight of unpayable government debt. But the parallels between 2025 and 1929 are even more precise than you might think. The parallels between 2025 and 1929 are so exact that it's like watching history replay itself, frame by frame. In 1929, stock valuations reached heights that had never been witnessed before. The price-to-earnings ratio of the Dow Jones Industrial Average hit 33, far beyond any historical precedent up to that point. In 2025, we're sitting at similar territory with the S&P 500 trading at 28 times earnings. The public back in 1929 believed that new technology, specifically electricity, the radio, and the automobile, had created a permanent new economy where the old valuation rules no longer applied. This time is different became the phrase repeated constantly in 1929, echoing through every conversation about the market. In 2025, artificial intelligence plays the role of that transformative technology that supposedly makes all the old rules obsolete. In 1929, margin debt, money borrowed specifically to buy stocks, reached record levels as everyone from doctors to shoeshine boys leveraged themselves to the hilt to participate in the boom. Stories circulated constantly about ordinary people becoming wealthy overnight through stock speculation. In 2025, margin debt as a percentage of GDP sits at similar extremes, but modern leverage extends far beyond traditional margin accounts. Options trading by retail investors has exploded to unprecedented levels. People are using credit cards to buy stocks. Companies are borrowing money to buy back their own shares at inflated prices. The leverage in the system is absolutely everywhere, hidden inside derivatives, options, and debt structures that most people don't understand and can't see. Wealth inequality in 1929 had reached extremes where the top 1% controlled approximately 25% of total income. This concentration meant that the economy depended entirely on a small number of wealthy individuals continuing to spend and invest. When they stopped, the entire system collapsed like a house of cards. In 2025, wealth inequality has reached even higher levels than 1929. The top 1% controls approximately 32% of total wealth, exceeding the concentration we saw in 1929. The economy depends on the top 10%, who control 70% of all consumer spending. If the wealthy stop spending because their stock portfolios crash, consumer demand disappears overnight, and the economy collapses. But here's where 2025 is actually worse than 1929. In 1929, most Americans weren't even in the stock market. Only about 10% of households owned stocks, which means 90% of the population wasn't directly affected by the stock crash. They suffered later through unemployment and deflation, but the initial crash didn't wipe out their savings because they didn't have savings invested in stocks. In 2025, approximately 58% of American households own stocks, either directly or through retirement accounts like 401ks and IRAs. This means that when the market crashes, it directly destroys the retirement savings of more than half the country. There's no insulation, no protective buffer. Everyone suffers immediately and personally. The banking sector in 1929 was fragmented across thousands of small banks with no federal insurance protecting deposits. When the crash came, banks failed because depositors panicked and rushed to withdraw their money. The lack of deposit insurance meant that bank failures wiped out ordinary people's savings completely. In 2025, we have FDIC insurance that supposedly protects deposits up to $250,000. But the FDIC has only about $125 billion in its insurance fund, while insuring approximately $10 trillion in deposits. If multiple large banks fail simultaneously, the FDIC fund is laughably insufficient to cover the losses. The government would have to print trillions to make depositors whole, which would destroy the currency through inflation. Either depositors lose their money through bank failures, or they lose their money through inflation. Pick your poison. The Federal Reserve in 1929 had credibility and room to act. They'd only been established in 1913, just 16 years earlier, and hadn't yet destroyed public confidence through decades of boom-bust cycles. They could have cut interest rates more aggressively, but they didn't understand what they needed to do until it was far too late. In 2025, the Federal Reserve has spent the last 15 years proving beyond any doubt that it cannot manage the economy effectively. They inflated a massive bubble through quantitative easing after 2008. They kept rates too low for too long, directly creating the everything bubble. Then they raised rates too aggressively in 2022 and 2023, causing inflation while simultaneously threatening to crash the economy. The Fed has lost all credibility. More importantly, they've lost the actual tools to fix the next crisis. The 2008 financial crisis provides an even more recent and relevant comparison to what's coming in 2025 and 2026. In 2008, the crisis began with subprime mortgages, loans given to people who couldn't afford them that were then packaged into complex securities and sold to investors worldwide. When housing prices stopped rising, borrowers couldn't refinance and started defaulting en masse. The defaults cascaded through the entire financial system, revealing that banks were massively overleveraged and holding worthless mortgage-backed securities. In 2025, subprime lending exists absolutely everywhere, except we don't call it subprime anymore. Auto loans with 84-month terms at high interest rates going to people with poor credit. Credit card debt at record levels with average interest rates exceeding 21%. Student loans totaling $1.77 trillion that will never be fully repaid. Corporate debt that quintupled from $2 trillion in 2008 to over $10 trillion today as companies borrowed at low rates to buy back their own stock. The leverage in the system in 2008 was primarily concentrated in housing and mortgage-backed securities. Banks like Lehman Brothers were leveraged 30 to 1, meaning they had $30 of assets for every $1 of actual capital. When those assets declined even 3%, the bank was completely wiped out. Lehman collapsed in September 2008, triggering the worst financial panic since the Great Depression. In 2025, leverage isn't concentrated in one sector. It's everywhere you look. The derivatives market now exceeds $600 trillion in notional value, which is 10 times global GDP. Most of these derivatives are interest rate swaps and credit default swaps that would explode if either interest rates move dramatically or if major corporate defaults begin. The interconnection means one failure triggers others, which trigger others in a cascade that cannot be stopped once it starts. In 2008, the Federal Reserve had powerful tools to address the crisis. Interest rates were sitting at 5.25% when the crisis began, giving the Fed substantial room to cut all the way down to zero. This stimulated borrowing and spending, helping to stabilize the economy. The Fed could also implement quantitative easing, buying trillions in treasury bonds and mortgage-backed securities to inject money directly into the financial system. The Fed's balance sheet went from $800 billion before the crisis to $4 trillion by 2014. This unprecedented money printing helped avoid a complete collapse, but it created the exact bubbles we're dealing with now. In 2025, interest rates are already relatively low, giving the Fed minimal room to cut. If they cut rates dramatically, they risk reigniting the inflation that just required painful rate hikes to bring under control. If they don't cut, they let the economy crash straight into depression. Quantitative easing is similarly constrained in 2025. The Fed's balance sheet is already over $7 trillion after multiple rounds of QE following 2008, and then again during COVID. They can print more money, but everyone now understands that printing money causes inflation. The 2021 to 2023 inflation surge, the worst in 40 years, proved definitively that you can't print unlimited amounts without destroying the currency's purchasing power. The Fed is trapped. Print money and destroy the dollar through inflation. Don't print and let deflation create another Great Depression. There's no good option because the tools that worked in 2008 don't work anymore after being overused. The government bailout capacity is also completely exhausted. In 2008, the government could borrow to bail out banks because federal debt was about 67% of GDP, which was manageable by historical standards. The Troubled Asset Relief Program, TARP, authorized $700 billion to buy toxic assets from banks. Additional programs brought the total bailout close to $2 trillion. This was politically unpopular, but economically feasible, because the government had borrowing capacity remaining. In 2025, federal debt sits at 125% of GDP, with trillion-dollar deficits stretching as far as the eye can see. The government doesn't have another $2 trillion to bail out failing banks and corporations. If they try to borrow it, bond markets will revolt, and interest rates will spike even higher, making the debt service even more unsustainable. The bailout option that saved the system in 2008 simply doesn't exist in 2025. The international dimension makes 2025 worse than 2008 as well. In 2008, China was booming and helped pull the global economy out of recession by stimulating domestic demand and buying commodities. Europe, while affected by the crisis, wasn't trapped in the same debt situation as the United States. Global cooperation through the G20 coordinated stimulus efforts across borders. In 2025, China is experiencing its own economic crisis with a collapsing real estate sector, local government debt exceeding $13 trillion, and a demographic crisis as the population shrinks. Europe is dealing with an energy crisis, demographic decline, and political fragmentation. There's no major economy in position to lead a global recovery. Geopolitical tensions mean cooperation is unlikely. When the crisis hits, every country will be fighting for its own survival rather than coordinating solutions. But the most reliable predictor of recessions over the last 70 years has been the inverted yield curve. And right now, it's telling us the danger window is wide open. When short-term interest rates exceed long-term rates, creating what we call an inverted yield curve, this has predicted every single recession since 1950, with absolutely no false positives. The yield curve inverted in July 2022 and remained inverted for 27 months straight, finally normalizing in September 2024. Historical analysis shows that recessions typically begin 3 to 12 months after the yield curve returns to normal, not while it's actually inverted. This means the danger window is October 2024 through September 2025. We're sitting inside that window right now as I'm speaking to you. The signal that has never been wrong is telling us the recession is imminent. Consumer debt has reached levels that make the 2008 crisis look manageable by comparison. Credit card debt exceeds $1.14 trillion, an all-time record in nominal terms. The average credit card balance sits at $6,800 per household, with interest rates averaging 21% to 28%. Credit card delinquencies, the percentage of borrowers 90 days or more behind on payments, have risen to levels we haven't seen since 2011. This matters profoundly because consumer spending represents 68% of the entire U.S. economy. When consumers can't borrow anymore and have to start paying down debt instead of spending, the economy contracts hard. We're at the point where consumers are completely maxed out. They can't keep the spending going that the economy requires to function. The commercial real estate crisis is unfolding in slow motion, but it will accelerate dramatically through 2025 and 2026. Over $2 trillion in commercial mortgages come due during this period and must be refinanced. These properties were financed when interest rates were 3%. Today's rates sit at 7% to 9%. A building that barely generated positive cash flow at 3% interest is completely bankrupt at 8% interest. The math simply doesn't work. Building values have dropped 40% to 60% in many markets because buyers understand the properties can't support the debt at current rates. When these mortgages can't be refinanced, the owners will default and hand the keys back to the lender. Regional banks holding these mortgages will realize massive losses that wipe out their capital completely. Regional bank failures in 2023 were a warning that very few people paid attention to. Silicon Valley Bank collapsed in March 2023 in the second largest bank failure in U.S. history. Signature Bank failed the exact same week. First Republic Bank failed in May 2023 and was absorbed by J.P. Morgan at a massive loss, covered by the FDIC. New York Community Bank teetered on the edge of collapse in January 2024. These failures occurred even though we weren't in a recession. When the recession actually hits and loan defaults surge across the board, dozens more regional banks will fail in rapid succession. The FDIC will burn through its $125 billion insurance fund within weeks. The government will have to print money to cover deposits, destroying the currency's value in the process. The concentration of market value in 7 stocks, the so-called Magnificent Seven, creates fragility that didn't exist in previous eras. Apple, Microsoft, Nvidia, Amazon, Google parent Alphabet, Meta, and Tesla represent 30% of the S&P 500's total market capitalization. Nvidia alone, with its price-to-earnings ratio above 65, accounts for approximately 7% of the entire index. If Nvidia's earnings disappoint, or if AI hype fades even slightly, the stock could easily drop 50% to 70%. That single stock declining would take the entire market down with it. This concentration risk is unprecedented in modern markets. When the market crashes, these 7 stocks will lead the decline. And because they're such a massive percentage of the index, the crash will be faster and more severe than anything we've witnessed before. Insider selling has reached levels that historically precede major market declines. Corporate executives have access to information that ordinary investors don't possess. They see the real earnings, the real pipeline, the real problems before anyone else does. When they start selling massive amounts of their own company's stock, it's a clear signal that they don't believe current prices are sustainable. Jeff Bezos sold over $13 billion worth of Amazon stock through 2024 and 2025. Mark Zuckerberg has been selling billions worth of Meta stock consistently. Nvidia executives, even as the stock was hitting new highs, were selling their shares. This is exactly what happened in 1929 and again in 2000. Insiders know when valuations are completely insane and they get out before the crash hits. Warren Buffett, the most successful investor in history, is hoarding cash at levels he's never maintained before in his entire career. Berkshire Hathaway's cash position exceeds $325 billion, the highest in the company's history, both in absolute terms and as a percentage of total assets. Buffett has been selling stocks, including reducing his massive Apple position substantially, and buying treasury bills instead. When asked why, he cited valuations being too high and being unable to find attractive investments at current prices. Buffett's own metric, the Buffett Indicator, which divides total stock market value by GDP, sits at 185%. He's stated publicly that a reading above 120% indicates dangerous overvaluation. At 185%, the signal couldn't be clearer or more obvious. The world's best investor is sitting in cash, waiting for the crash, because he knows with certainty it's coming. Unemployment has started rising from the 3.4% low we saw in early 2023 to 4.1% by October 2025. While 4.1% is still historically low, the direction of change matters far more than the absolute level. The SAM rule, developed by economist Claudia Sahm, states that when the 3-month moving average of the unemployment rate rises 0.5 percentage points above its low of the prior 12 months, the economy is already in recession. This rule has predicted every recession since 1970 with no false positives. As of October 2025, we're at or extremely near the threshold that triggers the SAM rule. The unemployment trend is rising, and once it starts rising, it accelerates rapidly as layoffs trigger more layoffs in a self-reinforcing cycle. Auto loan delinquencies have spiked to levels not seen since the 2008 financial crisis. Approximately 7.5% of auto loans are 90 days or more past due, the highest rate since 2009. Average monthly payments on new car loans exceed $740, and loan terms have stretched to 84 months, 7 full years of payments. This is subprime lending disguised with different terminology and marketed as normal. People who can't afford cars are being given loans they can't possibly repay. When they default, it affects not just the lender, but their ability to get to work, creating a cascade where job loss follows auto repossession. This serves as a leading indicator of broader financial stress in the consumer sector. Student loan delinquency rates have surged since payments resumed in October 2023 after a 3-year pandemic pause. Total student debt stands at $1,077 trillion, spread across 43 million borrowers. Many are choosing to default rather than resume payments, understanding rationally that the debt is so large they'll never pay it off anyway. This drains $100 billion or more per year from the economy as young people service debt instead of buying homes, starting families, or spending on goods and services. The generation that should be driving economic growth is instead drowning in debt that offers no economic return whatsoever. Geopolitical risks in 2025 include ongoing wars in Ukraine and the Middle East, the constant threat of China invading Taiwan, and the fragmentation of global trade into rival blocs. Any of these situations could escalate into conflicts that disrupt energy supplies, food supplies, or critical supply chains. An oil price shock, similar to what we experienced in the 1970s, would trigger stagflation, the combination of inflation and recession that's even more difficult to manage than recession alone. Markets absolutely hate uncertainty, and geopolitical uncertainty in 2025 is as high as any point since the 1970s. Commercial real estate defaults are already beginning among major institutional owners. Brookfield Asset Management defaulted on 2 Los Angeles office towers in 2024. Blackstone, the world's largest commercial real estate owner, has struggled with redemption requests from investors wanting their money back. These are the sophisticated players, the so-called smart money, walking away from properties because the math doesn't work at current interest rates. When the major players start defaulting, it signals that the fundamentals have broken completely. The defaults will cascade through 2025 and 2026 as more mortgages come due, triggering bank losses, more defaults, and eventual bank failures in a repeating cycle. The crash won't announce itself with a clear starting point that everyone recognizes. It will begin with something that seems manageable at first. An earnings miss by a major tech company, a larger than expected regional bank failure, an escalation in a geopolitical conflict, or a breakdown in debt ceiling negotiations. The trigger itself almost doesn't matter because the system is so fragile that any shock will start the cascade. What matters is what happens next, how one failure triggers another, which triggers another, until the entire financial system is in complete freefall. When Nvidia or another Magnificent Seven stock misses earnings projections or provides weak forward guidance, algorithmic trading systems will start selling instantly. The stock could drop 10% to 15% in a single day. Because Nvidia represents 7% of the S&P 500, that alone would take the index down 0.7%. But the real damage comes from the psychological impact. If the AI story that has driven valuations starts to crack, investors will question all tech valuations immediately. Microsoft, Apple, Amazon, Google, Meta, and Tesla would all sell off in sympathy. Within days, the Magnificent Seven could be down 20% to 30%, taking the entire market down 6% to 9%. This triggers margin calls across the system. Margin calls are the accelerant that turns a decline into a crash. When investors buy stocks with borrowed money and those stocks decline, the broker demands additional collateral immediately. If the investor can't provide cash, the broker sells the stocks to cover the loan automatically. This forced selling drives prices lower, which triggers more margin calls, which forces more selling. In 1929, margin calls created a downward spiral that couldn't be stopped. In 2025, margin debt as a percentage of market value sits at similar levels to 1929. When the selling begins, it will be rapid and absolutely relentless. Institutional investors managing trillions in pension funds, endowments, and sovereign wealth funds have risk management rules that require them to sell when markets decline beyond certain thresholds. These aren't emotional decisions made by scared individuals. They're automated processes built into the system. When stocks fall 20%, risk systems trigger selling to prevent further losses. This institutional selling adds massive downward pressure. Within the first month of the crash starting, stocks could easily be down 30% to 40% as retail panic selling, margin calls, and institutional risk management all drive prices lower simultaneously. The cascade moves from stocks to bonds as investors flee to what they believe is safety. But in 2025, Treasury bonds are not safe because the government needs to issue trillions more to cover deficits and refinance maturing debt. If there's a flight to safety at the exact same time the government needs to sell bonds, interest rates spike even higher. This creates what's called a doom loop. Higher interest rates make the government's debt service costs higher, which requires more borrowing, which requires issuing more bonds, which drives rates even higher. Countries caught in this doom loop typically end in either outright default or currency collapse through hyperinflation. The housing market freezes completely as buyers disappear and sellers are unwilling to accept lower prices. Homes sit on the market for months without receiving any offers. People who need to sell for job relocations or financial reasons start cutting prices to attract buyers. These price cuts establish new comparables that drive all home values lower in the area. Within 6 months, home prices could be down 20% to 30% from peak. Within a year, 40% to 50% declines are realistic in overvalued markets like Austin, Phoenix, Boise, and parts of California and Florida. Homeowners who bought in the last 3 years find themselves underwater, owing more on their mortgages than their homes are worth. Commercial real estate defaults accelerate as property owners realize they can't refinance maturing mortgages. They stop making payments and hand the keys to the lender. The lender, typically a regional bank, takes possession of a property worth 40% to 60% less than the loan amount. This is called a realized loss. When banks realize massive losses on commercial real estate loans, it wipes out their capital. Banks are required to maintain minimum capital ratios by law. When those ratios fall below regulatory thresholds, regulators close the bank immediately. In 2008, 465 banks failed over 5 years. In the coming crisis, we could see similar or higher numbers concentrated in a much shorter period. Bank failures create panic that spreads to banks that are actually solvent. Depositors see banks failing and rush to withdraw their money from any bank they perceive as risky. This creates a classic bank run. Even healthy banks don't have enough cash on hand to pay all depositors simultaneously because they've lent the money out or invested it in securities. When a bank run starts, the bank has to sell assets at fire sale prices to raise cash. Selling assets at fire sale prices creates losses that can turn a healthy bank insolvent within hours. The FDIC steps in to guarantee deposits, but the $125 billion insurance fund is completely inadequate for multiple large bank failures. The government has to print money to cover deposits, which starts the inflation process that destroys the currency's purchasing power. Employment collapses as companies facing declining revenues cut costs through mass layoffs. Tech companies that grew bloated during the boom start laying off 10% to 20% of their workforces. Finance companies heavily exposed to market declines cut staff across the board. Consumer discretionary companies facing customers who can't spend close stores and eliminate positions. Within 3 months of the crash starting, unemployment could rise from 4% to 7% or 8%. Within 6 months, 10% is realistic. Within a year, 12% to 15% unemployment is likely as the cascading failures move through every sector of the economy. The Federal Reserve faces an impossible choice. They can cut interest rates and implement quantitative easing to try to stabilize markets. But this risks reigniting inflation before it's fully been tamed. Everyone remembers 2021 to 2023 when inflation hit 9% and destroyed purchasing power across the board. If the Fed prints trillions again, the dollar will collapse and inflation will return even worse than before. Or they can let the crash play out, which means depression-level unemployment and a decade or more of economic stagnation. There is no middle path. The tools that worked in 2008 don't work in 2025 because they've already been overused, and everyone understands the consequences now. For the average American with a 401k or IRA, watching their retirement account decline 60% to 70% will be devastating in ways that go beyond just the numbers on a screen. Someone who spent 30 years saving, who has $600,000 in their retirement account, will watch it drop to $200,000 or less. That's not a correction. That's the complete destruction of their financial future. They can't retire. They have to work 10 to 15 more years, assuming they can even keep their job through the recession. For people already retired and depending on portfolio withdrawals to fund living expenses, the situation is even worse. They're forced to sell assets at the bottom to pay bills, locking in losses they'll never recover from. The psychological impact of watching everything you've saved disappear will be profound and lasting. In 2008, retirement accounts dropped but recovered within 5.5 years. Most people who held on eventually got back to even. In the coming crash, recovery will take much longer, if it comes at all. Japan's stock market crashed in 1990 and didn't recover to those highs until 2024, 34 years later. An entire generation of Japanese investors never recovered their wealth. The same thing could happen in America if the crash is severe enough, and the recovery takes decades. Housing wealth destruction will trap millions of Americans in homes they can't afford to sell. The job market for young people entering the workforce will be absolutely brutal. College graduates in 2026 and 2027 will find no entry-level positions available anywhere. Companies won't be hiring. The jobs that do exist will have hundreds of applicants competing for each position. This generation will start their careers 5 to 10 years behind where they should be, suppressing their lifetime earnings permanently. Studies of people who graduated into the 2008 recession showed they earned less over their entire careers compared to people who graduated just a few years earlier. The coming crash will be worse, meaning the economic scarring will be deeper and last longer. Small businesses will be decimated as consumer spending collapses and credit becomes unavailable. The local restaurant, the small retail shop, the family-owned service business, these will fail by the hundreds of thousands. Large corporations with access to capital markets will survive, though smaller. The economy that emerges from the crash will be even more dominated by massive corporations with small businesses playing a diminished role. This reduces competition, innovation, and economic dynamism across the board. Social safety nets will be strained beyond their capacity as unemployment surges and tax revenues collapse. The government will be caught between increasing demands for services and decreasing ability to fund those services. Spending cuts will be necessary even as more people desperately need help. This creates a humanitarian crisis on top of the economic crisis, as vulnerable populations, the elderly, disabled, and unemployed, face reduced support at the moment they need it most. Political instability follows economic collapse throughout history. The 1930s saw the rise of extremist movements across Europe as economic desperation made people vulnerable to authoritarian promises. Weimar Germany's hyperinflation helped create the conditions that brought Hitler to power. The United States isn't immune to the political consequences of economic catastrophe. When people lose everything, they look for someone to blame and someone who promises radical solutions. The 2025 crash will reshape American politics in ways we can't predict, but that will likely be profoundly destabilizing. So why is 2225 worse than 1929 and 2008 combined? Because we have the asset bubbles of 1929 in stocks, the debt bubbles of 2008 in housing and credit, and the government debt bubble that didn't exist in either previous crisis. All three are happening simultaneously. In 1929, only stocks crashed, and only 10% of Americans were affected directly. In 2008, housing crashed, but the government could borrow to bail out banks, and the Fed could print money without causing inflation. In 2025, everything is crashing together, and the tools to fix it don't work anymore. The Fed can't cut rates to zero because inflation is still elevated. They can't print unlimited money because they just did that and caused the worst inflation in 40 years. The government can't bail everyone out because it's already drowning in $36 trillion of debt. The 12 warning signs I've shown you, from the inverted yield curve to Warren Buffett hoarding cash, aren't speculation. They're facts. They're happening right now as I speak. The inverted yield curve that has predicted every recession since 1950 is telling us the recession is imminent within the next 3 to 9 months. Regional banks are failing. Commercial real estate is collapsing. Consumer debt is at record highs with delinquencies rising. Unemployment is rising. Insider selling is at levels that precede crashes. Every indicator is flashing red simultaneously. The timeline is clear based on the yield curve normalizing in September 2024. Recession typically comes 3 to 12 months later. That puts us in the window of December 2025 through September 2026. Commercial mortgage refinancing peaks in 2025 and 2026. Credit card defaults are accelerating right now. The trigger could come at any moment, and once it starts, the cascade will be unstoppable. This isn't prediction. This is pattern recognition. The same patterns that preceded 1929 and 2008 are present now, only more extreme. When the crash comes, stocks will drop 65% to 80% from peak, worse than 1929's 89% drop, because it will be faster and more concentrated. Bonds will drop 35% to 50%, something that didn't happen in previous crashes. Real estate will drop 40% to 60%, worse than 2008's decline. Unemployment will exceed 15%, and recovery will take not 5 years like 2008, but 10 to 20 years or more, because the Fed has no tools left and the government has no borrowing capacity left. The everything bubble earned its name because everything crashes together and there's nowhere to hide. Those market crashes in history books, the ones we thought could never happen again because we learned from the past, are about to repeat with a violence and scale that will shock everyone who believes it can't happen. The mathematics of unpayable debt, overvalued assets, and exhausted policy tools guarantee it. The crash is coming. The only question is whether you'll be prepared when it arrives.